We're running out of superlatives to describe Canada's economy. It's been the star of G7 nations this year, running at the fastest rate since the tech boom. And the broad strength cuts across most industries and regions, suggesting durability. But the great economic news has led the central bank to lift policy rates twice in just 2 months and lit a fire under the currency. In this videocast, we asked 3 questions. Can Canada's economic party continue to rage? Will the Bank of Canada turn on the lights? And will the loonie go even higher? The answer to each question, we believe, is no. The main reason Canada's economy did so well this year is that financial conditions were never more supportive this century. Low interest rates, past currency depreciation, rising oil prices, and soaring house prices in southern Ontario can explain a good portion of the over 4% increase in real GDP in the past year. But the bountiful economic harvest has also sown bad seeds. Interest rates have risen 0.5 percentage point, the loonie has shot up 10%, and new policy rules have cooled southern Ontario's overheated housing market. As well, the recovery in oil prices has stalled. So while economic growth should stay healthy next year, it is unlikely to repeat this year's act and will likely slow to just over 2% pace in 2018. Expected slower growth will mean 2 things for the Bank of Canada. First, it can shift to a more relaxed pace of rate hikes. In fact, recent comments from top officials stress the need to assess the impact of higher rates and a stronger currency on the economy and debt-laden households. This will take time, so don't expect a quick follow-up move. Barring further positive surprises, we think the bank will wait until January to pull the rate trigger again. Second, because the economy is now close to full employment, while interest rates are still far below neutral, the bank will need to continue normalizing policy. This likely means lifting the policy rate from 1% to 2% next year and a little more thereafter. A shift to slower rate increases will take the wind out of the loonie's sails. In fact, with the central bank expected to merely match additional moves by the Federal Reserve, the interest rate spread between the 2 countries will provide less support to the currency next year. We see the dollar slipping to 80 cents US in coming months before firming toward 83 cents at the end of next year. It's likely near the exchange rate's fair value that balances prices in the 2 countries and has a neutral impact on growth. To wrap up, an expected shift to more moderate economic growth will likely temper further increases in the dollar and interest rates. This in turn should reduce recession risks and support equities. Thank you.